Hi CA students, let's revise CA final AFM Advanced Capital Budgeting Decisions. Practical question 26. A machine used on a production line must be replaced at least every 4 years. Cost incurred to run the machine according to its age are. So they have given the cost incurred along with the scrap value at each year, and they are asking that this machinery has to be compulsorily replaced at every 4 years, but they are going for a check where is it optimal to replace at 4 years. So future replacement will be with identical machine with same cost. They are telling whatever cost incurred here, the same will incurred when we replace also. Revenue is unaffected by the age of the machinery, so revenue is same throughout the life of the machine. Ignoring inflation and tax, determine the optimum replacement cycle. So they are asking us the optimum replacement cycle. PV factor for 15% has been given. So going further, in case of optimum replacement cycles, we already have scrap value at the end of every year, so we have to calculate NPV 4 times, like at the end of year 1, at the end of year 2, at the end of year 3, and then at the end of year 4. Then finally, since it is the NPV which we calculate is of different life, then we have to calculate the equivalent annual cost by how will we find out? By dividing these NPVs which we found out divided by the annuity factor. Then we can compare at which stage we can replace at which year we can replace the machine. Going to the solutions, first they've done this working note to calculate the NPVs. This is not an NPV, it's just a net cash flow. So on a net, how much was the cash flow? In case of first year, the cash outflow will be 60,000. That will be in all cases, same for all the cases. And in first year, the maintenance is 16,000 and the residual value is 32. So net of 16,000. Then like that for 2 years, then 3 years and 4 years. And going next, they are discounting it with the 15%. Since they have already given the present value factors, we have to use those only. And as we can see in this table, they have calculated NPV. If we replace the machinery within 1 year, there is a negative NPV of 46,000. And then going further, for 2 years it is 72, for 3 years it is 98, and 4 years it is 1,24,968. Here they have given only cost, maintenance and repair cost. Revenue they have not given, so we have to check whichever is the least NPV. The replacement cycles for okay, now after we got this NPV, we have to divide it by the annuity factor. In case of first year, the annuity factor and PV factor will be same, so we are getting an equivalent annual cost of 52,997, and for 2 years 44,536, for 3 years 43,114, and 4 year 43,772. As we can see, it is least in the year of 3, so at the end of year 3, so it is ideal to replace the machinery at the end of 3rd years. Since EAV is least in case of replacement cycle of 3 years, hence machine should be replaced after every 3 years. Thank you.